companies, there's a little too much froth in REITs, that's real estate companies, as well as utilities. Yesterday we were talking about that utility chart. It looks just like the Chinese stock market. We're going to tell you what to do after the break.
Our next guest thinks now may be the perfect time for some strategic profit-taking. Alan Lancz, president of Allen B. Lancz & Associates, editor of the Lancz Letter.
I'm Carol Massar in today for Rhonda Schaffler. You are watching Bloomberg's Open Exchange. Our first guest managed to steer clear of the tech bubble and its subsequent burst. He also avoided financials last year. Alan Lancz is editor and publisher of the Lancz Letter and director of research at LanczGlobal. He joins us in studio on this Friday. Good to have you with us.
Thanks, Carol.
I want to ask you, Alan, you did avoid a lot of bubbles in the past, including the financials. How come? What kind of kept you away?
Well, there's a number of things, I think. When you look at transparency, accountability, and greed, and those are all mixed together, it's usually an area or a time to be very careful.
But what specifically? What tipped you off that you were seeing kind of greed if you were within the financial community?
Well, the financials, what we saw is you know, they kept on increasing their earnings, but it was how they were increasing their earnings. They were doing it by excess leverage. They're increasing their dividends. Unfortunately, that made a lot of conservative investors get in thinking it was almost like a utility or you know, a safe investment, when actually they were taking more and more risk.
The market was moving higher. We said it was going to be a much more volatile year, and that's what's happening. Companies like Microsoft and Apple are great companies, but we started to sell some just because of the incredible gains. A good pullback here would be actually a positive, I think, for the long-term health of the market, and few quarters of major gains would set us up for a big fall. So I think this escalation of this coronavirus that occurred this weekend has really pressured stocks overseas and in the U.S., and I think that's a good thing. It shouldn't just go straight up.
He says a big concern is its impact on the supply chain and stock market.
Any kind of disruption that occurs that was unexpected, like a coronavirus, will have a much more sudden and quick impact.
Hi, this is Alan Lancz, Director of Research at LanczGlobal. Welcome back. We weren't going to do this video. There's been so many people doing videos about how to invest in a bear market and how to invest under COVID-19 that we were like hesitant, but when we basically popular demand or just a lot of requests, we thought, let's do this, keep people informed. Historic times, incredible opportunities to make money, but also incredible opportunities to lose money. You have to be in the right areas, and that's what this session is about. It's disaster averted. We have averted disaster by opening up the states. That 45 most critical days in the U.S. financial history are past us. And we opened up successfully. We've done the right things, had 50 days of the best market in history. And just to get you caught up, this is what we were saying May 18th, 2020, about opening up as the market was rallying into its 50 best days in history.
The Dow is up 911 points today with the stock market way up. Could it be a sign that our economy is making a quicker bounce back from mid-March when the pandemic began? Today's rally had a lot to do with good results on vaccine tests for the virus, but there's also a lot of optimism out there as more people are going back to work and able to get out of the house. Alan Lancz from Lancz & Associates says states opening up has reinforced a belief that the future looks better. If you're an investor or keeping an eye on your 401k, this is good to know. It's a lot of money on the sidelines right now. What you do depends on where you think we're going in this pandemic.
Know what you own and avoiding transportation, hospitality. Some of those companies are down just tremendously. So if you think that this is it and we're coming back to normalization, which is what America's striving for, then it might be a good time to buy those. Spirit Airlines 47 down under 10. American Airlines, 50, 60 under 10. But again, if you don't, this is a pandemic nobody's gone through before, then basically know what you own and then be in the right area.
We'll hear more from Alan Lancz all this week on a number of financial topics.
So that's what we were saying May 18th. After about 50 days of the best recorded gains in history, most of the stocks were up. The area that hadn't been up yet or hadn't advanced were the area that got clobbered the most, the travel industry. The area that we said to avoid back in January, February. We were warning about, you get all these new videos now. don't find out what they're saying now in the midst of this pandemic. Find out what they were saying in January and February when the market was hitting all-time highs. That's going to be more meaningful. But the point is, travel hadn't moved up. What we're saying on this video on May 18th is, if you're a speculative investor, stock market hasn't really been good for Spirit Airlines, the cruise lines, a lot of the other airlines and travel-related, hospitality, hotels, etc. Buy them. They're probably going to go up. They're at new lows, and $40 for Spirit buying at $8, it's worth a chance. And that's all we were trying to say on that video from May 18th. Since then, we did an interview this week, June 22nd. They fragmented it down through the whole week, so we get bits and pieces. But this is what we had to say initially as the market was hitting all-time highs on the NASDAQ, even in the face of this pandemic, and even about rumors about a second wave, or have we even finished the first?
As our economy comes out of the viral pandemic, it might take years to decide when it's actually over with. We've talked with experts about a V-shaped recovery that's quick. A U-shape might take more time, but when will we actually know we're there? 10 years from now, when historians look back on it? Alan Lancz from LanczGlobal Investments, a financial planner, tells me we are not in recovery just yet. Bond market yields are still down. There's a lot of money out there looking for good investment.
No way are we going to be back to normalcy where these companies are going to have earnings that are predictable, and that's why you're right. I mean, a year or 2 years from now, we can look back and say this was the bottom or whatever. But right now, it's a situation where assess your risk levels. If you had too much risk going into the year and have done nothing, this is a gift. Take advantage of that gift and reduce your risk. Mitigate risk by reducing risk when prices are high.
A lot depends on the coronavirus, and with cases going up in a lot of states, the markets had a big sell-off today. The Dow was down 710 points.
So living through historic times, unprecedented time to make money. What we're saying here is take some profits, especially on these travel industry stocks that have surged so much when I don't think the international airlines are going to be back to normal even in 2021. This is going to devastate many areas. Real estate is going to be changed forever. Office buildings from down to even student housing and areas that people thought were safe. And it's very critical now to really be on top of the situation. And that's why we're doing these videos to help out. And it's a situation where in this unprecedented time to make money, be happy. It's a gift that the market's up so much. If you failed our words of warning in January and February, you didn't heed those words of warning, consider it a gift now that the markets are up. We were saying to get out of the S&P 500 because they own so much of the travel-related stocks, cruise companies, hotels. Even if you avoided those, you would have done so much better off than in that 38% drop. Now that you've got much of that recovered, and even on the NASDAQ hitting new highs, really assess your situation. And like I said in that interview, if you're taking too much risk January and February and did nothing or thought you'd ride the wave, consider it a gift and mitigate risk now.
Stock market isn't as volatile as it has been, with 800-point fluctuations on a daily basis seemed like, but it still seems shaky some days. Seems like there's one foot on the gas pedal, the other foot on the brake. The economy is opening up with optimism. Spikes in COVID, you get pessimism. Makes it hard for people who invest your money for a living. I've talked to Alan Lancz many times through the viral pandemic from LanczGlobal Investments. He says we're living in historic times that we'll be talking about for decades as the dust finally settles. He says take advantage of volatility. If the market goes way down, buy quality stocks. If the market goes higher and companies are above where they even were before the crash, take the profits now. Sell.
Oil was negative, actually. Now it's over $40, the first time since March. Take advantage of that. If you own too much energy, take some profits. I mean, negative oil made no sense. That was a great opportunity. Utilize this irrational behavior, this emotional behavior to your advantage. It's an unprecedented time to make money, but don't follow the herd. Those are the ones that are going to be holding the bag, and who do I sell it to? And that goes down from real estate. I think a lot of people that are jumping on real estate now are jumping in too early. Who are you going to sell it to?
We'll hear more from Alan Lancz all this week. Tomorrow he talks about buying airline stocks and risk tolerance.
So again, consider it a gift. If you bought energy when it was zero or negative, which nobody expected, and it surged over $40, very close to where it was even before the pandemic, I'll lighten up. It's a situation where what we're doing this week is taking profits in those speculative cyclicals, because the economy is not going to be a V-shaped recovery. It's going to be difficult. We're not out of the woods yet with the coronavirus. And I think it's going to be more taxing than investors think. So take advantage of that. What we would do with those profits is start buying quality. This is what we did into the height of the selling. We bought companies that would come out of the pandemic stronger than they went in. And that was the Amazons, the UPSs in interviews on TV. We mentioned those. Those were the first companies we bought. And then into this massive sell-off, buying the high quality fortress balance sheet type companies. We would go back to those type of companies now because they've been ignored and these speculative stocks have gone up. So again, rather than riding the wave, take advantage of these market extremes and don't follow the herd, but be doing the opposite of what the average investor is doing. In many cases, you're taking less risk and have better long-term results.
The stock market has had a lot of volatility since mid-March, hasn't it? Wild fluctuations up and down. We see the Dow go way up one day, we see it go way down the next. But some companies, some stocks do better than others. Depends on where they fit in our economy right now. Alan Lancz has never seen the likes of this viral pandemic, so even he's surprised by some effects on Wall Street. Spirit Airlines was $40 a share earlier this year. It bottomed out at $8 a share. As they're bleeding cash, it has bounced back to $25 a share now. Think of the profit there if you bought it low. You can be active on the market with your 401k, but strap on a seatbelt.
You know, it depends on how risky you are, your risk tolerance, your time horizon, but utilize the extremes to your advantage. You're still going to have the volatility. It's not over. Especially like hospitality, travel. The international airlines area is going to take till 2021. So really, you know, if you think there's normalcy, then I think you're going to be disappointed. You're taking a lot more risk. If you think these are short-term swings and take advantage, buy when everybody's talking negatively and slamming on the brakes, and sell when people are looking at the glass half full, then I think it's a great opportunity.
We've talked about a V-shaped recovery, a U-shaped recovery as well. When will we even know the recovery's over? That story coming up on Wednesday.
We're going to be on Bloomberg tomorrow and talk similar aspects of the wave of behavior. And as you can see here, the first section is January 2020. When we started this video, we're talking about taking some profits, and you know, coronavirus was just hitting the mainstream. President Trump hadn't even stopped as far as travel in China, etc. And then you have a situation where greed hits. February, the market's hitting new all-time highs, even in the face of this pandemic. It was incredible to us, but for those that didn't sell, you could even sell higher. Then the market collapses. You can see going through indifference and denial that, oh, you don't need masks, you do need masks. Fear, all of a sudden, this is going to be worse. We're going to have millions of deaths. Panic to just sell everything. When you start seeing that, it's time to buy quality. Make sure you're getting some income. Interest rates are going to stay low for a long time, so take advantage of that. And then the final stage is what we're in now, and that's where we're got an incredible rebound. We went from doubt and suspicion and caution on the airlines to buying them. Robinhood's record number of accounts established. Hertz goes bankrupt. The stock triples of people buying a worthless piece of paper. Just incredible speculation. Great opportunity to get out of those areas and again focus like we did in March of 2020 on quality. And that's what we wanted to convey with this video. We hope to have you share this many times and to many people. We appreciate the sharing and the trending it was doing across the globe on our past videos, and look forward to seeing you again. Please let us know your thoughts. If you have questions, one real quick question as we end here is, I've seen a lot of interviews in the beginning of this video. Who is our best interview? And I think it would be a situation where J.P. McCarthy, when I was in my 20s, in the late 80s, it was a situation where he was incredible. Even though he was knowledgeable about so many areas, he was as good as any financial interview from the main CNBCs, Bloombergs, etc. CNBC, probably Mark Haynes, the late Mark Haynes was great, very knowledgeable, an attorney. I mean, he would say after an interview, I was sitting there in the studio, like, why did we even have this guy on? He said virtually nothing. And what he likes about us is we talk about selling, and that's important. When to take profits, not just buying something at a good time, riding it up and riding it back down. Final good interview nowadays. I mean, there's just so many good ones. I don't want to leave anybody out, but Bloomberg is excellent, and there's a wide variety of others that even locally I've been very impressed with. They're interviewing tens, if not hundreds of people a month, and to be on top of this, to just recap, this is a 20-minute interview that they, as far as cut up and edit into a few minutes a day, so people think I'm on every day when it's one 20-minute interview on Monday, the 22nd of June. Hope to be back to you next month. Have a great summer, have a great 4th, and thanks for sharing the video, and thanks for your comments. We really appreciate it.